All right. Today is Sunday, the 29th of September. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Although, let's begin with extending the apology from last week for not being present on consistent basis and missing on some videos. You might be aware that I've done an eye surgery recently and according to the official instructions, you're not supposed to look at the computer screen for about 2 weeks, but I got shit to do, so I looked at the screen for hours each day. But rest assured, if I ever get blind and I can't look at the charts anymore, I'm gonna sniff them for you. And the reason why we got the surgery, since a lot of you are asking, I got them cloudy eyes, and I couldn't see pretty good, so I had to squint. And it gave me kind of the James Bond look. And some of the unintended consequences of that is attracting a lot of women. And I was reminded that I was a married man. So I had to get the surgery to fix my eyes to look less attractive. That's what really happened, folks. But kidding aside, I got them Michael Jordan eyes. See, everybody's now afraid that Mike might be dying because he has those red, veiny eyes. And I say, the guy had red eyes since he was in his 20s. What are you talking about? You know what's really funny, though? I was talking to a Gen Zer family member of mine because I read this report that the Gen Zers, when they buy shoes, they don't have any loyalty to brands anymore. They just buy shit off TikTok. And we were talking about Nike because the stock crashed, and now it's coming back recently, but the question of sustainability, of course, that's another story. So we're talking about Nike and how the brand lost a lot of its allure. It's not cool anymore. And why would anybody buy the overpriced garbage that Nike produces? When you got New Balance, Skechers, Brooks, Hoka producing better shoes than Nike. And the kid goes, but it's the Jordans. That's what keeps Nike alive. Of course, out of curiosity, I asked, you guys know that Jordans, the shoe brand, is named after an actual human being, right? Michael Jordan. You know who Michael Jordan is? And he goes, yeah, the guy from the meme. The guy from the meme. That's what Michael Jordan got reduced to. I don't think he cares, though, because he got $5 billion in the bank. But again, I don't understand why folks are concerned about Michael Jordan's eyes all of a sudden. I mean, the guy been crying for years. Of course his eyes are red. But again, folks, since we have the eye situation going on here, so we're going to stick in this video to the market coverage. But for all of you who tune in for the macro coverage in this program, rest assured, we're going to talk about China. So there is a little bit of macro in it. But tomorrow, again, we're not going to make any promises because with promises comes disappointment. But we're going to give it a shot of producing our macro show tomorrow. It's going to be public, everybody, because we have a lot of important stuff. Of course, the decision by the Fed. Everybody wants to hear my full commentary about the 50 basis points cuts and where we go from here. Not to mention, of course, the insane geopolitical situation that's going on in the Middle East right now. So we'll talk about all of this and a lot more tomorrow. But in this program, we're going to stick to the market information and specifically China, because this week was the best week for Chinese stocks since 2008. A lot of folks have been hating on Chinese stocks, but now we got a catalyst that maybe you should hate them less, if not love them. Among many stimulative measures that the Chinese government took this week, including 50 basis points rate cut by the Chinese central bank and mortgage, stimulus for the real estate market, and of course, China, the latest, considering injecting $142 billion into top banks. Now, of course, the difference between the 50 basis points rate cut that the Federal Reserve did here, and then the measures taken by China. Because a lot of folks would say, look, Chinese stocks exploded higher after the cuts, but U.S. stocks went a little higher, but kind of seem struggling here. Why would we see Chinese stocks exploding higher because of a 50 basis points rate cut, but not U.S. stocks? Now, you got to understand that rate cuts don't do shit to the economy. They take a long time to fix the recession problems in any economy. What gives you an immediate boost in the stock market and asset pricing and in the economy too is stimulus. And that's the difference. China's doing stimulus. We're not doing stimulus yet. We've done 50 basis points rate cut, and I think it's a major mistake by the Fed. We'll talk about this in tomorrow's program. Because again, it doesn't really run into the economy. It takes a long time, and you're wasting ammo, much needed ammo. And oh, by the way, the bond market didn't respond to it. We've seen the 10 to the 30-year bond yields going higher, not going down. But anyhow, folks, The comeback of China, because it's been under stagnation, recession, the stock equities in China crashed already, everything is down. But a lot of top investors been seeing an opportunity coming in China. As the United States slows, we begin a rate-cutting campaign here based on fears of recession. Well, guess what? Maybe China will be coming out of a recession, and they can stimulate more. You got investor known as the Big Short, Michael Burry. He's been doubling down, tripling down on his longs in Chinese stocks, and it's finally beginning to pay off. And the latest, of course, on Friday, you guys might have watched the interview on CNBC. David Tepper came out and said that he's buying everything China-related based on Beijing easing programs. All in, baby. And of course, in this program, we're going to explore whether you want to go all in China or maybe some. What are the benefits and the concerns? But one step at a time. We begin with the benefits here. Why do we see China as an attractive investing opportunity right now? Well, valuation-wise, I mean, the U.S. equities were easing by 50 basis points, but again, I think that the 50 and more was already priced in. We've been rallying for almost a year now, based on the premise of rate cuts. So that's already priced in. And the valuations in the U.S. market are absolutely absurd because of the AI mania bubble. Chinese equities, on the other hand, much cheaper than U.S. and European equities. And frankly speaking, if we're pumping all of these equity valuations in the U.S. based on AI optimism, guess who else is doing AI? China's doing a lot of AI initiatives, but never really got the kind of bump that U.S. equities took. But then you look at Alibaba, for example. That's the name that comes to mind when we think about China. Look at the price-to-sales ratio for Alibaba, about 1.77. Amazon, 3.27. So clearly, Baba offers much better valuation. You look at the forward PE ratio. Baba is about 11, Amazon 32. So again, if you've been long U.S. equities and you look at these bloated, overbought stocks in the technology cohort, the Amazons, the Metas, the Apples, the Microsofts of the world, wouldn't China's stimulus at least allow for a rotation out of U.S. equities, let's say the mega cap companies, into Chinese equities, specifically technology companies? I think that's the case. That could be, of course, part of the reason why we've seen Chinese equities exploding higher this week, while U.S. equities trading in the red. At least the big caps were negative to flattish. We'll talk about that in a minute. Recently in this show, we've been warming up to China equities. And just last week, I said that I'm shifting toward bullish China, but I'm being careful with only Baba exposure. And among the reasons why, we didn't know about China's stimulus, of course. But as the Fed begin a rate-cutting regime, the dollar will be devalued. So right now, Chinese equities have double tailwind. The devaluation of the dollar by the Federal Reserve, and of course, the stimulus coming from China. Both of them, by the way, inflationary. We'll talk about that in tomorrow's program. But here's what we said regarding Alibaba's stock. In a recent live stream, I suggested that we go long Alibaba using a combination of options and buying shares. Take a look. Now, as an investor, if you think that Pinduoduo is going higher, then you got to remember that Baba is higher quality. And Baba went down in empathy of Pinduoduo. But now if Pinduoduo is going to rebound, then Baba becomes also attractive. So you got to look at Baba here. And if we do September, just give it a chance to work out and then see what happens. Let's go with the 85, about 6%. That's a little too steep. Let's do 82 since we're not so far from here. 82, and then we sell. See what the 90 is going to give. At 50 cents, that's okay. So we have 82 to 90. That's a good spread range. And we're risking about 185, 180 to make 600. Really good risk versus reward. So this is another trade that I want to do here with Baba. If we indeed seeing that Pinduoduo is bottoming. So let's go and see the flows here for Baba. Buy the 95 calls. Okay, good. 95, 150. They're buying way out of the money. So that's good. They're selling the 75 calls. That's okay because, I mean, that's already in the money. Somebody's booking profits. Maybe they rolled to one of these 95 ones. We're seeing the 80 being bought. So yeah, I do like Alibaba here a lot. The only problem, of course, is the dollar going higher. So if we have a spike tomorrow, it's going to be a problem. Let's plug in the dollar here just to see if the impact is really that significant or not. So here, see the dollar going down. Let's expand this a little bit more. Clean all this stuff up. Okay, so here the dollar going down. See, dollar goes down, Baba goes up, dollar comes back up, Baba goes down. So, but they've traded together before. Okay, so I don't want to be fixated on the relationship with the dollar. I want to look at Pinduoduo. If we have a bottom in Pinduoduo, I want to take a trade on Alibaba just as a proxy for Pinduoduo. And I want to own the stock, to be honest with you folks. I want to own the stock, so I might do the spread first. And if it works out, I'll buy something in the money, like in the money calls with expiration date of October, December. And exercise, and just if BABA goes higher, I'll own the stock. I know it's been frustrating for the retail investors and the bros on social media who've been pumping BABA for the year, but it's going to work out. You just got to give it a little more time. And here it is, the weekly chart for BABA. We see a massive breakout. And again, when you see such a huge breakout like this, usually there is more to come. But there are also risks to the optimist outlook re China. We'll talk about that in a minute, but let's explain to you here in details what do we look for? What kind of stocks are we looking at when we talk about the China theme? It ain't just the Alibabas and the Pinduoduos of the world. It's much more broad than that. For example, you got the pure Chinese stocks like Alibaba, Pinduoduo, JD, H Hotel Groups, Las Vegas Sands, Wynn Resorts, all of these pretty much Chinese companies now. ZTO, Yum Brands, but gotta be Yum Brands China, of course. You have metals, be it the commodity level or the stock level. For example, copper. In the stock level, we go with Freeport-McMoran. You have coal, that's another theme, Chinese theme. So Warrior Coal, that's another play. Valley, of course, another big miner from South America. And then you have aluminum in Alcoa. Some of the industrials, of course, rely on a lot of China revenue and exposure, such as Caterpillar, John Deere, Keysight Technologies. Of course, there are a lot of other names that we can include here, like 3M and Boeing. But you got to be careful because a lot of these companies are not pure China plays. So if there is a weakness in the U.S. economy, that's going to be a negative for them too. And in the case of Boeing, they have a lot more problems than China could solve. The orders are already placed in, they're already priced in, so new China stimulus is not going to be really good for Boeing. It depends on resolving their own internal problems, including the latest union strike. We also have the marine shipping theme, so we've been talking about this for a while because of the geopolitics and the Red Sea issues, but now, since we have stimulus by China, these names begin to gain some traction too. We have names like Madison, Star Bulk, Golden Ocean, Costamare. Any dry bulker really would work in this theme. Then you have U.S. retail businesses with a lot of exposure to China, such as Apple, Skechers, Nike, Starbucks, Canada Goose, Estee Lauder, Ralph Lauren, Marriott, among many more. You have the auto theme. Of course, we have the Chinese automakers, such as NIO, Xpeng, Li Auto, Tesla. And in that theme, of course, we have lithium producers such as ALB. China stimulus is good for agricultural companies with exposure to China, such as FMC, Mosaic Fertilizers, Corteva. China stimulus is pretty good for chemical companies like Dow, DuPont, Olin, Tronox, and Huntsman, and many more. Which ones do I like? Because not everything is created equal here. As I said, you have to use your head. Am I going to buy a company just because of China stimulus? What about the domestic economy if this company has dual exposure? So I'll show you what I like, but again, at the end of the day, it depends on what you like. You got to pick what you like here. You look at the charts, you study the earnings, the Chinese exposure, and make up your mind. Obviously, in the Chinese group, I do like Alibaba, as I said before. I do like Wynn Resorts because the business in Vegas is still doing okay, and now if we're going to stimulate in China, you might see the Macau business also coming back. We bought Wynn Resorts recently, and since we bought it, it exploded higher, as you can see in the chart. Unfortunately for me, of course, I sold a little too early. Now, if you don't want to pick names and you want to stick to an ETF, again, FXI will give you exposure to Chinese technologies, but mostly Alibaba. I do like BABA alone because I'm not sure about Pinduoduo and JD and the rest. But again, if you want to look at the inclusive ETF for China exposure, you can take the GXC. And you can see here in the weekly chart that we have a break above, a sloping line of resistance that we've been struggling to break above for a while now, at least since the beginning of 23. So we do have a bullish breakout in Chinese stocks, of course, led by the biggest weight of them all, Alibaba. Now, if you have BABA in your portfolio, you don't need the redundancy. You might pick Yum China, something that's not really heavy in the ETFs. But if you have BABA, then you don't need the FXI. You don't need the GXC either. Just keep that in mind. Now, when it comes to the metals, I do like them all. You know why? Because double tailwind, once again. The Federal Reserve is devaluing the dollar. That's good for metals either way. And then you have China stimulus. That's going to increase demand for metals. So we do like them all, copper, coal, any of the miners, aluminum. I like all of them, to be honest with you, but if you want to look at the miners ETF, for example, the XLB weekly chart, it looks as we've been consolidating in a range for years now, in what could be argued as a saucer bottoming formation. But we're breaking out of that. Again, consider the fact that the Fed is easing, along with China easing at the same time, which is inflationary, by the way. And inflation is good for metals. In the industrial cohort, I'm not sure about Caterpillar and John Deere and all of that because we also have the recession problems here in the economy, in the U.S. economy, that is. So sure, maybe China will increase some demand all of a sudden, but would it really make up for the loss in demand here domestically? I'm not sure about that. When I look at key side technologies, though, I do like this chart right here. Weekly chart, not confirmed yet, by the way. We do have a sloping line of resistance. We haven't broken and closed above, but we might do that this week, and if we do, then you have a confirmation for a bullish breakout. Again, marine shipping, I do like Matson and Starbulk. The other two, they're higher beta, so they're going to go up more when these stocks go up. They're going to go down more when these stocks go down and pull back. But they're kind of shady, too. So I do like Matson. That's the best name in marine shipping, the most reliable one. And then you have Starbulk. A lot of metals, fertilizers, agricultural products all shipped via Starbulk. And don't forget also that we have another tailwind for these kind of names. With the upcoming labor strikes in the East Coast, so that could also increase the marine shipping rates and increase the revenue for these guys because now you got to go to the West Coast. You got to go to the alternative costs. And that's going to be an added cost to the importers. But it's going to go in the pockets of the marine shippers. Now, in the retail category, you got to be really careful because a lot of you would assume that, hey, let's go with Nike or Starbucks. Sure, maybe China's stimulus will alleviate some of the concerns and increase demand a little bit. What about the domestic economy, though? We see delinquencies rising and saving rates going down and the poor and middle-class consumers not doing pretty good. Matter of fact, consumer sentiment in the U.S. was actually at 3 years low this week. Of course, initially these names like Nike and Starbucks will move higher, but we got to be picky here. This is once again an active market, not a passive market anymore. You got to pick your names really, really carefully. We'll talk about that a little more in a minute, but the names that I do like here would be Skechers. It's been increasing market share domestically, so it already has really good tailwinds, and now you alleviate the China concerns a little bit, and that's going to be good for the stock. And Estée Lauder, not because it's a good company, it's a garbage company really, but because it's way oversold. So this week we added Estée Lauder EL to the Maverick portfolio, and so far we've gained about 15% or so in about a couple of days worth of trading, so not bad. If you look at this weekly chart for EL, again, the stock crashed from top to bottom by about 80%. And this is why I do like it here, that at least you can catch the tailwind of short covering and score 10-20% worth of gains in, out, hello, goodbye. I don't need to love the company. Now, in the auto category, I do like ALB because that's it's closer to a metal, really. And it trades with metals. You have devaluation of the dollar. Lithium prices will gain, still not gaining as we expect, but the investors at least would assume that if you have shorts in ALB, you got to cover them because now you have the Federal Reserve cutting rates, devaluing the dollar, and you have Chinese demand for lithium maybe, keyword maybe, increasing. There's a lot of speculation, by the way, behind the positive reaction that we got in Chinese stocks and Chinese-related stocks this week. We'll talk about that in a second. But what about the agri stuff? I do like Mosaic. We've bought Mosaic recently via call options, and it has a sweet spot, to me at least, because this is the trade that made my bones in the business. If you're looking at the chart of MOS back during the GFC, in 2007, when I was working for a hedge fund, I made my bones with this trade. I suggested that the Federal Reserve cutting rates would increase inflation. And with that, of course, nat gas prices and crude oil prices. And one of the best plays that we should follow is MOS. Folks thought I'm crazy. What are you talking about? We have a recession coming. You want to buy a commodity at this point? But I did, and they were convinced to do it, and they made millions and millions of dollars out of it. So I'm hoping that I can replicate at least some of that. We'll see. And then, of course, you have Corteva. We've been owning that for years now. As to the chemicals, we do like Dow, Olin, Tronox. You can go with DuPont, too. It doesn't matter. They all trade together, really. But I gave you a morning brief, at least for the members of this show, on the 26th. And we talked about Dow and Olin and Trox. And since then, all of these stocks have been exploding higher. You look at Olin, for example. Again, all of them, they kind of look similar, the chemical companies. They've been consolidating for a long time. And now maybe they're breaking out to release all of that energy to the upside. And don't forget, of course, as the Fed cuts rates, dividend-paying stocks become more attractive. So in the case of chemicals, we might actually have a triple tailwind. One from the devaluation of the dollar, the second from China stimulus. A lot of these companies have exposure to China. And the third would be cutting rates. Yields go down. Now investors are flocking to dividend-paying stocks. Now, one cautionary note. Before you go crazy on a shopping spree and you buy these names, a lot of them in the short run at least, they're overbought. Any rebound in the dollar, they're going to pull back. So there is no need to rush here. The other problem, what is the reason behind the rally from a mechanical perspective that we've seen this week? And simply the reason is short covering. When somebody says, oh, we have China stimulus, if you've been short any of these names, wind resorts, lithium, the chemicals, the fertilizers, anything related to China, you're now incentivized to book your profits, aka short covering. And that's really the juiciest part of the trade. And maybe that's going to be this week, maybe into next week, who knows. But that's the easy part. The difficult part comes from the validation of the theory that China's stimulus will increase demand in the economy. And this is why we're going to be subject to the fluctuation of data. If you get bad data from China, then folks would say, oh, we need more stimulus because whatever the Chinese government has done, that's not enough. And these stocks would go down. If you get good news, you'll see these stocks going higher. So the easy part is during the short covering. And maybe we have a little more of that coming. But after that, it becomes more challenging. And we got not so good data recently from China. Take a look at this headline, for example. China industrial profits plunge by 17.8% in August from a year ago. So again, it's a long way to recover in Chinese equities and the Chinese economy. And this trade is not going to be as easy as it was this week going forward. Keep that in mind. And this is why you have to be picky. We're no longer in the lazy, passive investment garbage period that we've been relying on. Now you got to pick your stocks. There is something called thematic investing, and it's a really important concept to understand. You see, this week we've produced a trilogy called Walking on a Tightrope. And we got really good reviews from the members who watch these videos. Because the Fed cutting rates by 50 basis points and the economy still holding gives you the impression of a soft landing. So right now, the market, you can see the hesitation. Sure, we're floating higher, but there is a crisis of identity. What do we do now? We've been jerking off to the prospects of 50 basis points rate cuts for almost a year now. And the question is, now what? Where do we go from here? So you see the market kind of tiptoeing, walking on a tightrope, but you have wind blowing from both directions. One we call the inflation wind, and the other we call the recession wind, the duality of the risk. And it's just in time. One of these winds will knock us off the rope. In the meantime, there's a strategy you can follow. So long as we're walking on the rope, this is the strategy that we've been doing. We have the long but hedged category. These are the defensive, the dividend-paying names, the value stocks. I mean, you have utilities, XLU, XLP, staples, IYR, real estate, the defense contractors, telecom, names like Coke and Walmart and Philip Morris, the healthcare names in the XLV, Gold, McDonald's, mid-cap value, IWS, SPYV, any value ETF really, and then you have any dividend ETF that you like, DVY, SPYD, doesn't matter, and IBM, a value play, dividend paying in technology. And as rates come back, because remember, we have the inflation wind. Anytime you get an inflation piece of data, rates will go higher. It ain't going to be good for this category. And this week, we've seen yields going higher, and we've seen these names pulling back a bit. But you got to remember, we welcome the pullback in these names because these are the new big caps. Reliability in the long run in these names. So we actually want to see more pulling back in these names because it'll give you an opportunity to get in if you're not already in. Now we have the pick category, and this is divided into 3 subcategories. One, of course, related to the dollar, and that's the miners, metals, energy, and some of the industrials. And as you've seen, the dollar went down. As the dollar continues to go down, these names tend to outperform. Now, before I forget, because the question would be, what about energy? Because energy was not a good performer this week. And the top question that I got this week came out with all of the geopolitical risks that we have and the flare-up in the Middle East. And on top of that, you have China's stimulus and the Fed devaluing the dollar. Shouldn't that be the best times? And by the way, even the data for supply was actually down this week. So shouldn't all of this be good for oil? The answer is yes, but oil is also being heavily manipulated before the election. We have the highest short float against oil in history on record. Now, with that comes risk, of course. If we begin to get more and more tailwinds for energy, you're going to see the mother of all short squeezes. But for now, they're trying to push energy prices down because we have an election season. Another one before I forget, because I just remembered. I should have done that a couple of minutes ago, but again, better late than never. A lot of you would look at the China slide and say, hey, what about chips though? I did not include chips because chips are already fully valued, number one. Number two, we have a lot of restrictions on chip exports to China. Doesn't matter if it's a Democratic or Republican administration, they're all going to be hawks against China. So I'm going to skip the chip conversation altogether. But we go back to the rope strategy, and in the pick category, we have the neutral ones, not really tied to the dollar or bond yields. These are cyclical businesses like the airliners, the IYT, the transportation stuff, travel, hotels, casinos, retail XRT, the industrials XLY, or XLI rather, and autos, General Motors, Ford, and the rest of them, Home Depot, Lowe's, the restaurants. I would say it comes to preference here. I've been long the airliners, for example. I've been short retail businesses. So it depends on your preference here on which one you want to pick. But then you have the yield-sensitive category. You're only going to pick those if yields go down. We're not talking about the 2-year, by the way. That's what the Fed can control. So this is the Fed's mistake. We'll talk about that in details in tomorrow's video. The Fed thinks by cutting 50 basis points, they're gods. They're going to ease financial conditions of the economy using their magic wand of rate cuts. It doesn't work that way because the Fed has control over the short end of the yield curve, not the long one. So what happened after the cuts, the 2-year went down. That's what the Fed really controls. But the 10 to the 30 went higher. And these kind of names, the small caps, the regional banks, biotech, the home builders, constructions, named like Blackstone, they need rates to go down on the longer end of the yield curve, the 10 to the 30. And that actually went higher. So these names underperformed this week. But now you know, if you see yields going down, you want to go along these guys. If you see the dollar continuing to go down, then you want to stick with the dollar-sensitive category. If you see the dollar moving back up, or you look at the charts, you see a risk of the dollar rebounding, then you hedge those names, you buy puts, you book profits. There are many hedging strategies that you can use. What about the rent category in the big caps? I think a lot of them are becoming fully valued. We talked about the charts in the last weekend's video. We know that Apple has problems with the iPhone shipments. We know that Meta, now Zucchini, of course, he can't help himself. You have one of the leanest businesses in history, not just in the market today, in history. All what you got to do is just sit down and enjoy. But he has this stupid fantasy of the glasses and the metaverse, and he's going to spend his way to destroy the stock again. And then, of course, NVIDIA came back a little bit this week because of the news that Jensen Huang may be done dumping. Of course, for now, that's the key. He's going to dump more. And I think we nailed the action in NVIDIA this week on our Discord. Initially, we went with the 130 calls in, out, hello, goodbye. Then we explained to you mechanically what the market maker will be looking at in details. Fascinating conversation. The members who followed will tell you that it was absolutely fascinating because we predicted that NVIDIA will be pushed below 125. That's what the market maker wanted to see. And then it's going to reach 120 by Friday. And that's exactly what happened. But it's going to close above 120. And it did. So what we've seen in NVIDIA this week was a mechanical phenomenon. It remains to be seen whether we're going to see follow-up by the investors buying the stock or buying call options, because you got to remember something important. I'm going to go back to the SPX, the S&P 500, in the year 2007, when the Federal Reserve cut rates by 50 basis points. And the argument, of course, back then we needed the 50 way more than we needed right now. So I think that the Fed made a huge mistake by the 50, but again, that's a topic for the conversation coming tomorrow, hopefully. But you can see the moment that the Fed cut rates back in 07, the S&P actually rallied by about 7%. That was the top, and then we crashed. So it is really important for you to understand that you're not going to be seduced by a rally without merit. And this is why we call it the walking the tightrope analogy, or period. It requires really a delicate approach in investing. So long as we're walking the rope, we're going to follow this guideline. But if the wind hit us, be it the inflation wind or the recession wind, then the strategy changes. And we talked about that in details. But again, we go back to thematic investing and why active investing is actually making a comeback, which is my favorite. I don't like the dog shit, lazy, passive investment garbage that you people have been doing for years now. But suppose you just say, Maverick, you know what? I don't care about these themes or what the Fed is going to do and not do, the dollar yields. Who cares? Just buy the S&P and go to sleep. Okay, this is the 3-month performance for the S&P. You can see the SPY up about 9.25%. And it's been flattish for a few weeks. But then you look at gold, the GLD, for example, up 19% in the same period. And we said back in July 11th that we bought gold. We think it's going to go higher. You want to add the GLD to the portfolio. And we did. And since then, it's been exploding higher. So thematic investing is really important because you're going to see a lot of stuff that went higher already, stagnating if not going down. and you see the stuff that's been waiting for such news, monetary news or China news, beginning to gain steam. Look, for example, at the weekly chart for NVIDIA. This guy been flattish for over 100 days. So if you're all in NVIDIA, you haven't rotated at all. You've been flat. At the same time, we've done some buying of the airliners, for example, and recently, since we bought a stock like Delta, it's up over 30%. So thematic investing becomes really important, that you follow these themes rather than just being stuck in one theme that you're comfortable with or you've been used to, because right now the game is changing. And it's really important for everybody to understand that. Anyhow, folks, once again, a reminder, the macro conversation, hopefully, fingers crossed, would be tomorrow. But right now, let's add more color to this conversation about the market and revisit the weekly activities, beginning with the closing of the indices on Friday. And here we go. The diamonds closing in the green by 137.89 points, or a gain of 0.33%. The Nasdaq, on the other hand, closing in the red, the laggard of the day, down by 70.70 points, or a loss of 0.39%. The Spider also closing negative by 7.20 points, or a loss of 0.13%. And the leader of the day was the Russell 2000, even though it was the laggard for the week. Why did the Russell 2000 make a comeback Friday? Because the PCE report did drop the 10 to the 30 bond yields. But we need to see confirmation of that. If they continue to go higher after that, then forget about the Russell 2000. But on Friday, it did close positive by 1.48 points, or a gain of 0.68%. We look at the sectors for the day. That's Friday, of course. Leading the pack, energy, but it is the laggard for the week, as you'll see in a minute. Utilities come at number 2, and the beauty of utilities right now, you have the safety tailwind, the dividend tailwind, and now all of a sudden it becomes an AI play, because everybody realized that, to power all of these data centers, we need electricity. Duh. But believe it or not, a lot of these names are already trading at absurd valuations. I think folks who are early on the trade, they caught that tailwind a long time ago. So this is a Johnny-come-lately trade in utilities, but it's an added tailwind that keeps utilities leading week after week. Comm services at number 3, but the laggard, technology, pulled back in chips led by NVIDIA. It's a mechanical phenomenon again, so we see technology at the bottom. Now we contrast this theme for the week, and you see that the leader was metals, double tailwinds, the evaluation of the dollar, and China stimulus. Consumer cyclicals, of course, that includes China names, so that leads at number 2. Industrials, we talked about why. Technology, we've seen a pump in NVIDIA for the week. Mechanical element again, so that's contributing to technology going higher. Micron earnings also kind of contributed to that. Utilities, we talked about it, but healthcare and energy come at the bottom. Now, the problem with healthcare, as we get closer to the election season, both parties, the Democrats or the Republicans, will pick on the favorite boogeyman, which is big pharmaceutical companies, the health insurance companies, so we see them going down. But once they get into office, they remember who the top donor is. They're owned and controlled by the big pharmaceutical companies. So again, the pullbacks in these kind of names, I see as an opportunity to buy. The other laggard for the week, energy, we talked about why. I think there's a lot of manipulation, but with the recent flare-up in geopolitics, also the potential of a massive short squeeze. Looking at the breadth on Friday, pretty good, beat kind of neutral. If you look at the NYSE, 65% advancing, 33% declining, and in the Nasdaq, 58% advancing, 39% declining. Look at the heat map on Friday. Again, the pullback was led by the chips, Taiwan, NVIDIA, AVGO. I think a lot of this is mechanical, led by NVIDIA, and NVIDIA dropping, of course, pulled the ETFs down. So all of them pulled back. The big caps were muted. The leader was Google, closing positive, but Google is, I would say, the one chart in the big cap technology stocks that is not overbought right now. Amazon is among the overbought, so we see it pulling back on Friday. Then, of course, you have the regulatory scrutiny against the Ozempic mania. Not to mention, of course, that the generics are now becoming widely more available to everybody and cheaper. So we see Eli Lilly and VO going down for the day on Friday. But besides that, the China theme was okay. Baba, Pinduoduo, some of these cyclicals that we talked about. Tesla, a lot of the industrials that we talked about relating to China. The metals, same thing. Utilities remain hot for the reasons that we just talked about. And energy made a comeback Friday, but it's just a little comeback against the drop that it got for the week. So let's look at the weekly heat map. What we see here is quite different. Most energy stocks went down, with the exception of the highest quality one, which is Exxon. So right now, I've been talking about this for weeks, that going long energy at this point you need to begin with the highest quality, and that's Exxon, because it has the value tailwind, it has the dividend tailwind. So we go with Exxon, and then if we see a short squeeze in the commodity, it's going to open up a play to the other names, the higher beta names. The other contrast, of course, chips closing positive, so NVIDIA, AMD, Micron, of course, because of earnings, Intel, but a lot of these names, again, whether these tailwinds will last for the next few weeks or not, you got to remember there are a lot of risk from rotations. Folks been long these names for a long time, and now they become an ATM to book profits from. The China theme, the cyclicals, doing okay, the metals doing pretty good. For the week, of course, some of the dividend-paying stocks pulled back a little bit. You look at real estate, you look at the big pharmaceutical companies. Obviously, the XLV, if you own the ETF, it's going to suffer when you have three of the biggest names, or let's say four, going down big for the week. Eli Lilly, NVO, Amgen, and Regeneron. Wasn't a good week for healthcare for sure, but again, I think that the pullbacks will be opportunities to buy. The banks, not pretty good because on one hand, yields going higher. The 10 to the 30, not good for the regionals. And then with the recession concerns in the economy, the other banks are also flattish. JP Morgan's, Bank of America was actually down, as we see Berkshire Hathaway cutting more of its holding in BofA. If we look at the heat map for the ETFs, once again, no major move in the bond market. You see the TLT negative, but flattish for the week, all in all. When we look at the yield-sensitive stuff, let's begin with the risk on. IWM was negative. If you look at the KRE regional banks, was negative. If you look at the XBI biotech, was negative. But then you have other risk-on categories like the XRT retail, the XHB home builders, the ITB construction were actually closing positive. So that illustrates for you that it's a picker market. It's no longer, hey, I'm just going to be passive, buy ETFs, and don't bother with the themes. I'm just going to do okay. No, now it becomes an active picking kind of market. Let's look at the risk-off stuff. From the yield-sensitive side, the XLP staples flattish, the XLU positive, not by much though. Then you look at the IYR real estate was negative, the XLV healthcare was negative. Let's look at the dollar theme, because the dollar was down a bit, and of course we have the China stimulus, another tailwind added to the dollar going down. So we see right off the gate, Chinese equities, the FXI exploding higher, EEM, emerging markets also moving higher. We see gold, silver also moving higher, GLD, SLV, natural gas also moving higher. We see uranium continuing to go higher, and metals, XME, XLB, doing fantastic for the week. But the only laggard is oil. USO was down, and so were energy stocks, the XLE, XOP, OIH, all in the red. What do we make of the fact that the technology stocks and the chips closed positive? I think a lot of it came from NVIDIA and the earnings of Micron, but again, there's no reliable evidence that we're moving higher in a breakout in these names, not yet at least. Specifically, when you have the VIX, look at the VXX and UVXY closing positive for the week. Looking at commodities on Friday's session, we see a rebound in WTI, Brent, but again, it's just a small rebound and a big whack for the week, all in all. You got the RBOB flattish, heating oil, modest gain, but the leader of the week was nat gas, adding more to the gain with about 6% on Friday alone. We see the metals pulling back a little bit, perhaps. You got profit taking going on. Some of the grains mixed, of course, soybean meal. A lot of these grain commodities will improve if the China theme sustains, but it's early to say that we have a trend change, at least not yet. Looking at the week all in all, the leader, nat gas, with gains north of 9%. We see cocoa, soybean meal, coffee, copper, soybeans, lumber, corn, all among the leaders. The laggards, palladium, OJ, but a reminder these names have been up big, so we're just seeing profit taking here. Of course, it remains that we have the RBOB, WTI, and Brent. Those are the laggards for the week. Thank you to the manipulation and the extreme shorting that we see. But I'm confident that we will see all of this extreme shorting backfiring, and we see a big short squeeze in these names. Moving on to the big casino options, what do we see here? This is Friday's activities. Of course, the volume remains. It's been dead since the summer, really. And some, of course, attributing the phenomenon to all of the action moving toward the NVIDIA table. And folks now not trading Apple or Amazon or Meta as they used to, because you got NVIDIA. That's the biggest casino of them all. And the volume is concentrated in NVIDIA, about 5 million contracts, and then Tesla at about 2.4 million contracts. The rest, not really that exciting at all. We see the volume picking up in the Chinese names. That comes without saying, of course, but it's really important for us to look at the put versus call ratio. So you see that the puts are still holding at the 40s in NVIDIA and Apple. So those are still at risk here, that they could pull back. The more put feedback that the market maker gets, the more likely they're going to drop. And of course, the calls are bought usually at a higher ratio than the puts because folks are trying to accumulate or enter positions. So we see buying of calls in 25, in 26. That's not really that important to the market maker. What you need to look at is the week by week and the monthly expirations. And if we see more puts than calls in that time frame, then the market maker will pull them back. Now, another risk we have to be aware of is the IV rank. So if you have an IV rank closer to 100, it means that the majority of the gains in that direction that the particular stock been trading at is coming to an end because the pricing becomes unattractive. So in the case of Tesla, it's already at 100. This is the highest implied volatility going back a year. And of course, it happened as Tesla been going higher. So right now, Tesla is at high risk of pulling back. And this is why we're going to look at the chart in a minute and give you a hedging trade if you happen to be long Tesla. You look at BABA at about 91, so that's also coming closer to a pullback. Same with Intel, about 96 in the IV rank, so that's also coming closer to a pullback. So just keep that in mind. When we look at the options flows on Friday, bullish flows for Bilibili, Microsoft, GameStop, Costco, Futu, another Chinese name, TLT, IWM. We see bearish flows for Coinbase, SLV, Tesla, SPY, Amazon, KWeb, Taiwan, Eli Lilly. But most importantly, of course, what about the unusual activities? That's what we care about. Let's begin with the bullish activities. And I mean bullish for the VIX, but bearish for the market. Here we have a VIX bull call spread. Somebody bought the 25 calls and they sold the 45 with the expiration date of October 16th, spending about a little over $4 million. The implications from this kind of trade. As we hit closer to the election season, the risk is going to increase. You have the geopolitics, of course, you have the Fed's mistake, and the prospects of inflation coming back now with China's stimulus. And we all know that Japan is still a problem, the yen, among many of the problems that we discuss in the Wall of Worry all the time. So the trader here is betting that the volatility will increase, and it will shoot above 25 in the VIX, but it's not going to surpass 45 by the expiration date of October 16th. Bottom line is, we anticipate that volatility will increase. And that could cause a pullback in the market. Just keep that in mind. The charts will come in a minute. But here we have a diagonal call spread for Alibaba. Of course, if you're a Johnny-come-lately, it's not really Johnny-come-lately. The name just broke out this week. I should take that back. But if you chase the action after the initial pop, you know that you're overpaying for these options. Doesn't mean that the stock has to pull back, but you're overpaying because the implied volatility moved higher. So one way to remedy the fact that you're overpaying for the call options is to put yourself in the shoes of the market maker and play market maker for a little bit by opening spreads, meaning now you're a seller of options. And in this case, the trader bought the 120 calls for the expiration date of Jan 17th, 2025. And then they sold the 110 calls for a shorter expiration date, October 25, 2024. Hence, we call it a diagonal call spread, meaning that the trader believes that Alibaba will not close above 110 by the expiration date of October 25. But by Jan 17th, Alibaba would be way above 120. Of course, it's not my favorite trade because what if Baba explodes above 120 this week, or maybe pulls back a little bit, but then it goes above 110 by the expiration date of October 25? In this case, the trader has another plan. They bought higher quantity of the 120 calls than the 110 calls that they sold. That way, if indeed Alibaba explodes above 110 before the expiration date of October 25 for the 110s that they sold, they're still making profits because they have higher quantity of the 120 calls for Jan 17th. All in all, they spend a little over $3 million in those. And this trade comes hand in hand, but the trader here doesn't mind that they're overpaying perhaps because they're confident that the FXI, in this case, the China Large Cap ETF, is indeed heading higher. And they bought the 35 calls for the expiration date of Jan 17th, spending a little over $2.5 million. In the FXI, of course, one of the heaviest weight names, Pinduoduo, PDD. Recently, the name got whacked, but somebody sees it coming back based on the whole tailwind of China optimism. They bought the 150 calls, the expiration date November 15th, spending about $5 million in those. What about BA Boeing? I wouldn't buy it even with your money, but somebody did. They bought the 170 calls, and they sold the 180, so the risk is defined here. They're not being too greedy. It's a costly trade as I see right now. The expiration date is November 15th, spending about $1 million. And the idea here, we see perhaps a resolution of the union strike, and we see a short covering pop that takes us above 170 but not above 180 by the expiration date of November 15. And then we have GILD, Gilead. All of Big Pharma were down, but Gilead was sort of the exception. Maybe there's pending news coming. There's a name that we added recently in the Maverick Long portfolio, which is Bristol Myers. We got good news out of that name, with a new approved treatment for schizophrenia. And if you look around you, you know that we're going to need a lot of that drug. So that's a tailwind for BMY, but perhaps we have an approval coming for Gilead. And somebody bought the 90 calls for the expiration date November 15th, spending a little over $1 million. And then we have GLD. Speaking of gold, you got to stay long gold. Any pullbacks, buying opportunities. And somebody here bought the 255 and the 270 calls for the expiration date of November 15, spending about a little over $2.5 million. Here's another bullish one for you for MSFT Microsoft. Somebody see it going higher. I don't, but somebody does. And they bought the 450 calls, the expiration date February 21st, 2025, spending about a little over $1.75 million. And here's the last bullish one that we got for you for the SMH, the chip ETF. Of course, NVIDIA went higher based on the mechanical phenomenon. Now we want to know if we have a follow-up or not. Somebody's betting that we do. And they bought the 270 calls and they sold the 290 calls for the expiration date of Jan 17, 2025, spending about $6 million. Now, as I said before, even within chips, thematic investing, active investing, you see sometimes AMD going higher, the rest going down. You see sometimes NVIDIA going down, the rest going higher. Sometimes you see Intel going higher, the rest going down. So the ETF stuff is not my favorite, and you got to look at individual names. Now, if we look at the bearish activities, we begin with EWW, the Mexico ETF. So long China, short Mexico. Is that the bet here? Somebody bought the 46 and the 43 puts for the expiration date, December 20, spending over $1 million. What is the theory here? I have no idea, but they see something bearish coming from Mexico. And here it is, somebody buying puts on Taiwan. So you can go with longs in the SMH and think that everything is going to go higher. What if Taiwan goes down? What if we have geopolitical tensions with Taiwan, China? Somebody bought the 155 puts for the expiration date November 8, spending a little over $500,000. And here's the last one for you, Wynn Resorts. Now the stock exploded higher this week. Overbought, yes. Due for a pullback, yes. And this is what they're betting on. They bought the 95 puts for the expiration date October 18th, spending about a little over $350,000. Pulls back, if the China tailwind and optimism is still intact, and the dollar is still going down, and you pick it up and you buy Wynn. Let's do the charts and then wrap it up. We begin with the SPY hourly chart. Folks, once again, we're trading within the range of last week. There is a lack of decision making here. Everybody got the rate cuts. Okay, we got the 50 rate cuts. Now what? What do we do now? What do we buy now? And this is why we're walking on a tight rope until the wind knocks us or until somebody makes a decision. Some of the whales make a decision. And they made a decision in China. Can they make a decision within the SPY? That's what we're waiting for. And that decision, by the way, could be a buy or a sell, exit. So when we look at the daily chart, we know that we have a consolidation pattern and the chart broke above. Now comes the what now? What do we do now? And it seems that the market is struggling to attract buyers, especially buyers on the sidelines. I see that a lot of the buyers right now, perhaps the shorts covering or traders doing mechanical phenomenons, or perhaps some traders just trading based on the algos. But we're not seeing the sideliners, huge inflows coming in saying, okay, we got the 50. The sky is clear. Let's go all in and buy the SPY. We're not seeing that. Why the hesitation though? Perhaps we need to go down a little more to attract those buyers to finally step in. If that is the case, if we can't find buyers right now, the sellers are gonna. We might pull back to form once again a higher low. So no harm done. But it makes the number 564.20, which is the previous high, as our bull to bear advantage line. What does that mean? It means if we're trading above, the upside risk is more dominant. If we break below, then the downside risk becomes more dominant. And at least it'd be worth playing a pullback trade on the SPY. And the target would be, let's say, a pullback to the trend line, the actual trend line. If we break below the trend line, then we can talk about retesting the lows at about 540. But as I say all the time, one step at a time. Looking at the weekly chart for the SPY, what do we see here? Again, we go back to the wave. The wave began, let's say, around March of 23, the banking crisis, in which the Federal Reserve decided to bail out the banks. And we've seen the birth of a new wave, as we see in the MACD indicator in the weekly. The white line and the average trading above zero. That's when you know you have an official bull wave. You cross below the zero line. You know that you have the end of the bull wave, the beginning of the bear wave. But it's really imperative to understand and to analyze. Is the wave coming to an end? Is the bullish wave getting exhausted? We've pretty much exhausted all of the ideas that we have. And I think we are in that scenario. Sure, the candlesticks might be forming higher highs and floating higher, but it's not deceiving me. I see the bearish/negative divergences on the MACD and the RSI. And the problem here is it could be a tension pattern, and it resolves to the downside, and the wave ends either way. Go back to the '07 example. The Fed cuts rates, we go up by about 6%. Then that's the top, and down we go. What about the Qs, the weakest link right now? We can argue that maybe we have a bear flag and down we go, but again, it's been consolidating within the same range from last week, so we have lack of decision making. A lot of the gains that we got in the Qs this week came from the NVIDIA mechanical squeeze, so it is unreliable. Now looking at the Qs, we see the same thing with the SPY. Tension pattern broke to the upside, but there's the hesitation and the now what question. We got the Fed, the algos decided to cover the shorts, and the hedging got it. But where are the human beings? Who's buying here? And it seems like there is no answer. There's nothing that really encouraging the sideliners to step in. And again, if we decide to go down to attract some buying, then the bull to bear advantage line becomes 485.54. So long as we're above, upside risk is more dominant. If we cross below, then the downside becomes more dominant. And it's worthy to play a pullback trade. All the way where? All the way to the trend line. And then we can form a higher low and rebound higher again if we find buyers. If we don't find them though, we break below the trend line, then we can talk about revisiting the low from September. But again, one step at a time. Looking at the weekly chart for the Qs, the birth of the wave, about the end of the first quarter of 23, and now what? It seems that we've peaked, and we need to end the wave and begin a bearish wave. If that is the case, then you'll see the Qs declining. And the catalyst could be the Federal Reserve cutting rates, bringing back inflation. Could be the Federal Reserve cutting rates for the wrong reasons. Could be rotation into China or other equities that will bring the end of the wave for the Qs. So again, don't be deceived by the day-to-day action. Always look at the weekly chart. Before you go in and buy big and all of that, always look at the weekly chart and ask yourself a major question. Is the bullish wave continuing? Or is it coming to an end and it's about to reverse? That's the most important question. Looking at the IWM, small caps daily chart, see the same phenomenon. Tension pattern broke to the upside, and now the question of what do we do now? Of course, the answer here is easier than the Qs and the SPY, because the answer here, if yields 10 to the 30 go down for the right reasons, not for the recession reasons, then the IWM should break out in a bull flag pattern. But again, it's conditional. It's rates going down for the right reasons, not the wrong ones. Then you have the dollar. What do we see here? Flirting with breaking the trend and trading negative. We see a flush down in the dollar. And if we do, it's going to be pretty good for the metals and pretty good for the China trade. But again, it doesn't come without risks because we have a lot of macro data this week. We have the PMIs. We have speeches by the Fed zombies. We have the most important payrolls comes Friday. And those are going to have an impact on the dollar. But right now, looking at the chart, the bet is dollar goes down, which is pretty good for your boy, the old man, gold. Looking at the monthly chart this time around, because a lot of you say, hey, the daily's overbought. I don't know if I should buy right now. Let me show you something here. This is a cup and handle pattern that's been going on for over a decade. All of that energy is being released right now. And this is why I say that gold has a multi-year tailwind from this point on. And more devaluation of the dollar will be pretty good for gold. And this is why for now I see that the pullbacks are opportunities to buy. And remember, even on the monthly you can look at the RSI and say, but it's overbought, I don't like to buy here. Look at the last few times we've seen such an overbought reading. 3 out of 4 resolved with more upside. Only 1 resolved to the downside. And that was during, of course, the Fed tightening the monetary policy. This is the temper tantrum, the Fed is going to stop cutting rates. But right now, we're not even close to that situation, at least not yet. Another one, copper, looking at the weekly chart. We are at resistance right now, but look at the MACD, look at the RSI, the Vortex indicator, all pointing out for a bearish to bullish reversal. We might struggle a little bit here in the previous high because maybe we're overbought in the daily. But if we pull back and then rebound higher, we could be forming an inverse in shoulder pattern, and we're going to revisit the highs in copper. Welcome back. Inflation, thank you to the Federal Reserve. Looking at silver, the SLV still looking pretty good, but honestly, I'm a gold guy. I'm not a silver guy. I use the SLV to hedge my gold position. That's all the use that I can find for. If I look at the chart of the dollar, it appears that gold is going to go down because dollar is going to go higher. All I do is just buy the weekly puts in the SLV real cheap, and they compensate me for any loss I get in gold. Looking at the chart of crude oil, what do we see here? We're still fighting the sloping line of resistance. We're still fighting 72.5-ish, let's call it that. But we do have support at 67.71. The momentum right now remains bullish. We could lose it. The manipulation is still here. But if the tailwinds hold, the geopolitics, China stimulus, devaluing of the dollar, and the supply is coming in low. Of course, they made a fake article about, Saudi's going to increase the supply. Nothing came out of Saudi. And if that's negated, say Saudi comes out and say there's no truth to the rumors that the Financial Times reported on Friday, that we could see a short squeeze in oil, where it actually makes it above the sloping line, and then the next test would be 72.50. But boy, if we lose 67.71 again, let's call it 67 even, just to be a little more conservative, it's going to be a problem. It's going to be a problem because perhaps the extreme shorting that we see in oil right now because of a recession tailwind. What do we have this week? The payrolls. And if they come out disastrous, then oil is going to get crushed, of course. What about the 10-year yield? We're looking at a weekly chart this time around. We're at the trend line. And again, it is oversold. I think the 50 was already priced in and then some. I see the risk right now, to be honest with you, that the payrolls come out average or stronger than expectations. And we see the 10-year continuing to go higher, which means that the Federal Reserve wasted 50 basis points worth of ammo. And again, if the 10-year rebounds higher, is that going to be good for the risk-on category and yield-sensitive, such as the XHB home builders? No, I think it goes down. It only continues to go higher if bond yields go down in the 10 to the 30. What about the risk-off category, like dividend-paying, the IYR, real estate? It is pulling back. See, it hit resistance. It's pulling back a little bit because yields are rebounding. A bigger rebound this week, say by stronger payrolls, then you don't need the safety of dividend anymore. And we see the IYR going down even more. The question is, if that is the case, would it be good for a rotation from risk off to risk on, like the IWM? I don't think so. So the question at that point would be, where does the money go? That's going to be a topic of conversation for next week. But I give you a little bit of a hint here. Yields going higher. Wasn't that good for JPM, JP Morgan? The answer is yes. So if we see any flare-up that causes bond yields to go higher in the 10 to the 30, you want to go with JPM. And then you probably want to sell or short the KRE, which is right now flirting in or around the 50 days moving average in blue, but still forming higher lows. So again, yields going higher. For whatever reason, payrolls, doesn't matter what it is. Powell said something, who knows. You probably want to go long JPM and short KRE. Now, if you see yields going down, but an important caveat, going down for the right reasons, not recession reasons, then you want to go long the KRE. And whether it's the good reasons or the bad reasons, be honest with you, you're going to continue to be short JPM. Looking at the VIX 4 hours chart, what do we see here? In the last video that we produced for the members, we predicted that we will see a pop in the VIX. And indeed, we got it. Why? Because in the 4 hours, we've seen all of the momentum indicators coiling for a move higher. And indeed, we've seen the release of that energy on Friday. So it is a warning sign that you got to be careful. Some players here are not really trusting all-time highs. They're actually using it as a hedge. September is not over yet. We still got 1 day. And we still got the election risk and geopolitical risk and many more risks that we have right now. So I think that the VIX, as the trade suggested in the unusual activities, we're probably going to see the VIX back above 20 really soon. And by really soon, I mean by the monthly options expiration date in October. Looking at Apple, Big Kahuna didn't make up its mind. It's still consolidating just underneath the sloping line of resistance. It tried to escape before, but it couldn't close above. That's what's really important, and it couldn't do it. Now, is it just gathering the energy? And we'll see buyers showing up when we break above. That'll be a bullish confirmation. At that point, if you have shorts, like I do in Apple, you close them, and you probably want to go the long side. You want to bet for 235. If, on the other hand, we do this, and we can't break above the sloping line, then we're probably going to play an inverse ABC pattern all the way to closing the gap, and that's going to be in or around 223. So I guess you stick to being in the short side. Then you look at the weekly chart. It favors the short side right now, looking at the MACD indicator. It looks as the bullish momentum is coming to an end. We're about to reverse into bearish momentum. What about Tesla, the souffle weekly chart? We closed above the 200 weeks moving average, so we got a bullish confirmation of an inverse head and shoulder pattern. The problem is you got the IV rank at 100, so we could see a mechanical phenomenon where Tesla pulls back. Now, it doesn't matter if it pulls back 1%, 2%, 3% even. That's okay. But you don't want to lose the 200 weeks moving average because you can pull back and then make it all the way to the next resistance in or around 271. So what is the strategy here? Let's say if you bought Tesla recently or you've been holding Tesla. How about you buy an insurance policy for free? You actually get paid for it. And the insurance policy would be going to the October 18th expiration date, about 2 weeks from now. You sell the 280 calls because we know that we have 271 as resistance. And we know that the IV rank is at 100. So the possibility of going to 280 and above 280 is highly unlikely. At the same time, you want to protect yourself against the bearish confirmation, which is losing the 200 weeks moving average, sitting in or around right now 236. Let's call it 240 because it's going to continue to move higher. So you sell the 280, you buy the 240. Again, you need to have 100 shares or more. So if you have 100 shares, you can do this strategy by opening one contract each. You sell the 280, you buy the 240. If you have 200 shares, you can do two. If you have less than 100 shares, then you can't do this. Your only hedging strategy would be a stop loss. But if you do this strategy right here, you're getting paid about $230 a contract to insure your shares. And the question is, why not? What about NVIDIA? What do we do here? Still consolidating within range. You got lower highs, higher lows. So what do we do now? There's no confirmation one way or the other. We know the confirmation is if we lose the 100 days moving average in red, then we have a bearish confirmation. Bullish, of course, going to take closing above the previous consolidation, aka the lower high. And that's going to be in or around, let's say, 130. We didn't do that this week. You look at the weekly chart. Consolidation pattern, tension pattern. Right now, it favors downside than the upside. At least this is what the momentum indicators are showing. That could change if we see another squeeze and a break above. But until then, we can just yo-yo back and forth. Now that we got to the highs, we go back to the lows until we see a resolution. Looking at the hourly chart, though, maybe a leading indicator a little bit. It looks as maybe a topping head and shoulder, and we're going to break below 120. Revisit 117. We break below 117. Now we're back at 110.91. We're at 111. Let's just call it that. And we might lose the entirety of the mechanical squeeze that we got this week. So it is imperative that we see buying of calls for those who are NVIDIA bulls. That you see buying of calls out of the money, weekly expiration, bi-weekly expiration, monthly expiration, to resume the buying and hedging activities by the market maker. And lastly, Bitcoin. Tulips. What do we do here in the weekly chart? I don't have my bearish confirmation yet because we haven't lost the 50 weeks moving average in blue. I don't have my bullish confirmation of breaking above and closing above the sloping line of resistance. Because right now we can argue it's a cup and handle pattern. But unless we have a break one way or the other, there's nothing I can do about it here. Once we have a break, I got a trade for you. And we talked about it. It's probably going to be, if we break the 50 weeks moving average in this case, it's going to be short micro strategy. If we break above, it's probably going to be long Coinbase. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? Beginning Monday, we have a bunch of Fed zombies speaking from Bowman, the only dissenter, against the 50 basis points rate cut. And then we have the Chicago Business Barometer, PMI, but the most important speech come once again from the big zombie himself, Powell. Of course, this week he did a speech, but he did not talk about the policy. Will he talk about the policy this time around or not? If he does, he might step on a landmine. Then Tuesday, beginning of the month of October, we have the manufacturing PMI, construction spending, job openings, and a lot of Fed zombies from Governor Cook, Richmond President Barkin, Atlanta Fed insider trader Bostic, Boston Fed President Collins, all talking about technology-enabled disruption. What the hell do they know about this? Anyhow, looking at Wednesday, ADP employment report for the private payrolls. And then again, a bunch of Fed zombies. The new one from Cleveland, we have Beth Hammock. She's replacing Chucky. And then we have St. Louis and Governor Michelle Bowman again, and Richmond Fed zombie Barkin. And then Thursday, we have initial jobless claims, these services PMI, factory orders, and another duo from the Fed zombies from Minneapolis, Kashkari, and Atlanta Fed insider trader Bostic. Lastly, Friday, October 4th, the most important day of the week. We have the non-farm payrolls. That's going to have the most important impact. on the dollar, of course, and bond yields. And now you know what to do with that. They go up, what do you buy, what do you sell? If they go down, what do you buy, what do you sell? And then we have another speech, and this time around from New York Fed zombie Williams. And with that, folks, once again, love and appreciate all of you. Thank you for joining me tonight. If you like the show, please press the like button, press the subscription button, leave us a nice comment, and better yet, join us as a member. We do a lot of work during the week. You can do it here on YouTube, you can do it on Patreon so you don't have to pay Google, and if you do it, please make sure that you're not using the YouTube app on your iPhone, because then you're paying Apple, you're paying Google, you ain't paying me. But with that, folks, hope you enjoyed the show, but this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Tell him the good part.
The good part, William, is that no matter whether our clients make money or lose money, Duke and Duke get the commissions.
Well, it sounds to me like you guys are a couple of bookies.